Okay, let's continue talking about money price levels and inflation. Let's finish this chapter today. And our next subtopic is money market. So money market is similar to most other markets. The market for pizza, the market for chocolate, the market for all those things. How have we looked at markets in economics? The way we've looked at markets in economics is with a simple chart, price on the vertical axis, quantity on the horizontal axis, and in this case, the price for money is, of course, interest rate. In the short term, it's the nominal interest rate. If you want to borrow from the bank, you will get some money. You will demand some money from the bank, and you'll have to pay for that. The price that you have to pay is the interest. So as you see on this chart, on the vertical axis, you'll have the price of money, which is the interest rate. On the horizontal axis, you'll have the quantity of money. A bit of a source of confusion over here is that this quantity of money is the economy is actually more or less the same as the supply of money. Remember, we mentioned before that the supply of money is all the deposits and the cash in circulation. That's all of that together is the quantity of money in the economy. That's also the supply of money. So that's a bit confusing because we might actually confuse the horizontal axis with the actual supply curve on the chart. And we'll see that the supply curve looks a little bit different in this simplified version of the money market, in which case the supply curve is actually just a horizontal line. I'm sorry, vertical line. This is our supply. And that's why the confusion between this vertical line and the horizontal axis is not really that important. Whatever is the number you take for money supply, let's say it corresponds to 3 trillion on the horizontal axis. That's 3 trillion, just a number on the horizontal axis. It's equal to the money supply, which is more or less fixed jointly by the central bank and commercial banks. Remember from the previous class we mentioned how the central bank creates money and how commercial banks also create money without even being able to print money. So all of those processes will create some given amount of money in the economy. And for simplicity, let's say the money supply is fixed, so we have a vertical line. Let's add the line of demand here. So demand for money. That will be our demand for money. And it actually depends on several factors. Before we mention those factors, what is demand for money? Do you want money? Do you want to get rich? Yes, most people want to get rich because perhaps even if you don't care about those pieces of paper in your wallet, in your pocket, but what you might care about is what those pieces of paper will allow you to afford. Do you want to be able to travel? Do you want to be able to afford going to nice places, like travel all over the world? Do you want to be able to afford a high quality education, high quality healthcare? Even if you don't care about money, you might want to be able to afford those things. So I think I'm probably right saying that most people want to get rich. But the trick over here is that demand for money is not the willingness of people to get rich. Okay, what is money? In the economy, money is the liquid assets that you have. Remember from several weeks ago, I had this interesting question. When you say, how much money do you make? In ordinary life, that makes sense because in ordinary life, this word money actually means income. How much income do you earn? But in economics, money has a specific meaning. That's a liquid assets. So the question, how much money do you make, doesn't really make sense in economics. You would probably want to use the word income instead. So how does it relate to the demand for money? Well, demand for money actually shows how much of my total assets do I want to have in liquid form. How much of my total assets I want to have in liquid form. My total assets perhaps include my house, perhaps a couple of cars for the family, perhaps some financial and other types of investments. And my total assets will also include some liquid assets, some cash in the bank, cash in the pocket. So the demand for money over here actually shows what percentage or how much of my total assets do I want to have in liquid form, in the form of money. Okay, and that will depend on several factors. So the amount of money that I want to have out of my total assets will depend on these factors. The price level. If the price level is increasing, higher price levels will mean that I'll need more money to afford to buy things. So higher price levels will increase demand for money. Interest rates. Higher interest rates means that if I keep cash rather than having my assets in the form of financial investments, I will lose out more on not having those investments, because those investments might generate interest for me. So higher interest rate means that instead of keeping cash, I will want to have my assets in the form of financial investments, which will generate that higher interest rate. So higher interest rate means lower demand for money. Real GDP. Greater GDP we produce, there is more things for me to buy. Hence, I also want to have more money in order to be able to buy those things. Increase in real GDP increases my demand for money. And financial innovation makes it easy to switch between financial assets and money. For example, if you look at, I don't know, 100 years ago, if you want to get the money out of the bank, there were no ATMs. You had to go to the bank, which was probably 20, 30, 40 kilometers away. It's hard to get your money out of financial investments into the actual form of cash in your pocket. In that case, you'd have a lot of cash in your pocket prepared already. But with greater financial innovation, as it's easy to buy and sell financial assets just at a click of a button, I don't need to keep as much cash in my pocket. I don't need to keep as much cash on my bank account, because if I need cash, I can easily, very, very quickly sell some of my financial assets to get cash. So financial innovation actually reduces the amount of cash I want to keep. Now, talking about the money supply, we've talked about this last week. Central bank has three policy tools, three tools that it can use to change the money supply. I remember the open market operations, where it buys or sells government bonds from commercial banks, changing the required rate of return, and lending some money to the commercial banks. So with that, those three tools, as we discussed in the previous class, the central bank can change this money supply. And similar to any market, a market for pizza, market for chocolate, as you did already in your Economics 1 classes, you of course can also calculate the equilibrium in this market. The equilibrium here will consist of the price, which in this case is the interest rate. I'll use I for that, for the nominal interest rate, and the quantity of money, in this case 3 trillion. So let's say, for example, I'll give you an example. Let's have a look at this example. Let's say demand for money is given with this equation. Interest rate is equal to 36% minus 0.002 times the quantity of money in the economy. And the supply of money is, let's say, 3 trillion. Let's say everything is measured in billions, so let's make it 3,000 billion. Okay. Can you calculate the equilibrium over here? What would be the interest rate in that equilibrium? And how much is the money supply in that equilibrium? I'll give you a hint. Money supply, because it's a vertical line, at that equilibrium is already given by this number over here, which is 3,000 billion. Just plug 3,000 billion over here. I think what you're going to get is interest rate is equal to 30%. I'm not sure, I haven't done the calculations. I'm just doing them right now in my head without taking any notes. So you can double check those using your calculator. And of course, because you already have worked with demand and supply curves for however many weeks, since all the way back from Economics 1, we can also have some changes. If I tell you, for example, that the money supply changes to 4.2 trillion or 4,200 billion, I could ask you, what is the effect on the interest rate? What is the new interest rate, and how much is the change in the interest rate? So all these sort of questions, you can try to practice those when you have time at home. And talking about the changes on the market, when the central bank changes the money supply, let's say the money supply increases over here. The economy, remember, doesn't jump immediately from the previous point over here. Let me call this point A. It will not jump immediately all the way over here to this next point. I'll call it point B. It'll take time for the economy to adjust from this point A to point B. And the way it will adjust is that once money supply is changed by the central bank relatively quickly, right? The ongoing interest rate on the market will be a little bit too high. At that interest rate, people would only want to have a relatively little amount of money in their pockets, in their banks. But the actual money supply in the economy, the money held by all of the population, is quite a lot compared to the interest rate. So what will happen? Well, people will start to convert the extra cash that they have, the extra deposits that they have, into financial investments. Let's say they will start buying bonds. Price of bonds increases. So let's say, for example, we start with a bond which has a price of 1,000, and let's say it pays coupon payment, the regular payments of, let's say, $100 per year, just for example. As you see over here, this bond pays me 10% per year. But if everybody is buying bonds, demand for bonds increases. So the price of bonds increases. Let's say it goes up from 1,000 to 1,400 for this bond, which still pays $100 in coupon payments every year. Or alternatively, it's a company stock, the company share, that pays $100 in dividends every year. So if you look at the percentage, now, as opposed to the price of the bond, as opposed to the price of the share, the dividends of the share or the coupon payments on the share are smaller in percentage terms. If I want to invest into this bond, I need to pay $1,400, and in return, I will receive $100 every year. So the interest rate is now lower on this financial investment. So this interest rate drops gradually as the prices of bonds gradually increase. And that's the way the economy will adjust from point A to the new equilibrium at point B when money supply increases. And vice versa, when money supply decreases, previously the economy was at point B, now the money supply has dropped, the interest rate will not jump immediately, perhaps it will take time for the economy to adjust. At the ongoing interest rate, people have very high demand for cash. You see, demand is very high, but the supply is very little, so they have shortage of cash over here. This distance is the shortage of cash. When they have a shortage of cash, what are they going to do? They will try to convert other assets into cash. They will start selling financial assets, let's say bonds and stocks. The prices of bonds and stocks are going to drop. Let's say here's an example of a bond, or maybe this is a stock, whatever it is. The price is going to drop from 1,400 down to 1,000. If it's a company stock that used to pay a dividend of $100, let's say it continues to pay a dividend of $100, but in relation to the price, this dividend is now larger percentage. If you want to receive this dividend over the next several years, you don't need to pay $1,400 anymore to buy this stock, to buy this share. You only need to pay $1,000. So the interest rate that you will receive on investing into this stock actually increases, and that's how the economy will adjust back to this point A when the money supply decreases. So in the short run, the effect of the changes in money supply on the interest rate is as follows. When the money supply increases, as you've seen, interest rate goes down, and when money supply decreases, the interest rate goes up. But this is an effect only in the short term. Again, let's say we are here at point A, and let's say money supply increases due to the bank expansion in monetary policy. For the short term, in the short run, the economy will move down to this point B. As money supply increases, interest rate will go down, but the effect in the long term is a little bit different. In the long run, again, we start with the increase in the money supply. That's actually what central banks have been doing for many years already, all the way since at least the global financial crisis. Central banks keep printing money, increasing the money supply. Interest rates keep dropping. Interest rates at the time of 1980s, 1970s were at around 15%. Imagine earning 15% on your deposit in the bank. What can you earn on your deposit in the bank right now? Around 1%. So anyway, money supply increases, interest rates go down, but the changes in interest rates also translate into the change in the real interest rates. If interest rates go down, not immediately, but over time, the real interest rates will go down as well. We've talked about the real interest rates a few weeks ago when we talked about the chapter of finance, saving, and investments. So you can review that from your Moodle notes. Now, if the real interest rates are down, then it becomes cheap for you to borrow to buy that car that you wanted, and it becomes cheap for you to borrow to buy that refrigerator or a microwave that you wanted. So everybody starts to borrow more and spend more money. Consumption as part of GDP increases, and if real interest rates are lower, then it also becomes cheaper for you to borrow to open up that company that you always wanted. So investments also increase. Both of these are part of GDP. So GDP increases as well. Production is much higher. All of this consumption, people buying all of those refrigerators, microwaves, cars, all of this investment, new businesses opening up and buying up all the electricity and energy that they need for all the new businesses. All of that drives prices up. Prices keep increasing. So price level goes higher. And as the price level increases, that means the money supply, the money that you have in your pocket, actually has less real value. Real money supply decreases. Let's say, for example, you have 1,000 NT in your pocket. A few years ago, for 1,000 NT, you could buy a lot of drinks and quite a few lunch boxes. Nowadays, after a lot of printing, perhaps with price level increasing, the same 1,000 NT doesn't buy you as much. So the value of this money is actually lower. Money supply has dropped in real terms. That means the interest rate will decline. That's a small I over here. As the real value of this money supply drops, that all happens gradually. First, initially, the money supply increases quickly from the tools of the monetary policy. But gradually, as all of this process takes place, real money supply gradually goes back to where it was, bringing GDP down as well. As interest rates are higher, it's now expensive to borrow. People don't borrow to buy that car. People don't borrow to open that business. GDP goes down to where it was at the long-term equilibrium. So in the short term, this monetary policy of printing money can actually help the economy to get out of the recession. But if there is no recession, printing money doesn't actually help the economy in the long term. It only brings higher and higher and higher price levels. It only brings inflation. So there is a bit of a long-term connection between the amount of money in the economy and real GDP. And that connection is actually the whole theory in economics, and it's called the quantity theory of money. Quantity theory of money has this form. Money supply M multiplied by the velocity of money. Velocity is another word for speed, is equal to the price level multiplied by real GDP. So what is velocity of money? It's the speed of money. Basically, it's how fast money changes hands. If, let's say, we have $3 billion in the economy and the real GDP is actually $10 billion. Real GDP is everything that is actually bought and sold. How can we use only 3 billion to buy and sell things for 10 billion? Well, it means that the same dollars will have to change hands several times. So that's where velocity of money comes from. And of course, if we're looking at changes in these variables, then we can rearrange the formula a little bit as well. Changes in money supply plus the changes in velocity is equal to the change in price level, which is inflation, plus GDP growth. GDP growth is, of course, the change in real GDP. So what quantity theory of money says is that by just printing money in the long run, in the long term, we can't really affect GDP. We've discussed this a few minutes ago. And also, by printing money, we cannot really affect the velocity of money. The velocity of money is mostly affected by financial innovation and things like that. So money supply over here doesn't affect V. Money supply over here doesn't affect Y, the real GDP. So the only thing left that the money supply can affect is price level. Meaning that when we print more money, price level increases, keeping this equation true. And if money supply drops, price level drops as well. That's all in the long run, in the long term. Of course, in the short run, as you know, there is an effect of changes in money supply to interest rates and to GDP as well. So there are a couple of formulas that you probably want to take note of as well. And one last formula for today is a more complicated formula for money multiplier compared to what we learned last week. Last week, we saw that the money multiplier is equal to the change in money supply divided by the change in monetary base. When the central bank increases the monetary base by, let's say, 300 million, if money supply changes by 1.2 billion, then of course the money multiplier is equal to 4. We've discussed this last week. And now a more complex scenario, a more interesting formula for money multiplier is in front of you. Where C is the currency drain, where C is the cash in circulation, currency in circulation, and the currency in circulation divided by D, where D is total amount of deposits in the economy. And that gives you the currency drain, the percentage of deposits that people would like to keep in their pockets as cash. We talked about currency drain in the previous class as well, so you can go back to that video and review it. R is bank reserves, so the ratio of bank reserves to deposits is the desired reserve ratio, the amount of reserves that the banks would like to have as percentage of their deposits, something like this. So of course I can give you different examples to try to calculate things using this formula. So let's say you have this example over here. Let's highlight that with this table. Currency in circulation 600 billion, million, whatever it is. There are many banks in the country, but the total balance sheet of all of the banks in the country looks like this, let's say. So you have all the things that you need. R for reserves are over here. D for deposits are over here. Currency in circulation, cash, is over here. And let's say you have a couple of questions to answer. How much is the money supply? And how much is the money multiplier? Well, money supply is all of the deposits in the economy plus all of the cash in circulation. In our example, I think it's going to be 3,300. Correct me if I'm wrong. And the money multiplier, just plug in all the numbers. I think you'd get something looking like this. And the answer over here is money multiplier is 3.67. So if the central bank increases the money supply by, let's say, 100 billion, the actual money supply will increase by 367 billion.